What if I told you that everything you've been taught about building wealth is overcomplicated? That you don't need to time the market, pick winning stocks, or have some secret strategy? That the path to financial freedom is so simple, it can be summarized in 3 words. Just keep buying. Sounds too simple, right? That's because the financial industry doesn't want you to know this. They make money from complexity, from trading fees, from management fees, from selling you courses and systems and strategies. But the data tells a different story. Here's a fact that will blow your mind. If you had invested $100 every week into the S&P 500 for the past 30 years, through every crash, every recession, every crisis, the dot-com bubble, the 2008 financial collapse, the 2020 pandemic, you'd have over $700,000 today. You wouldn't have needed to predict anything, time anything, or do anything except keep buying. The secret to building wealth isn't complicated. It's consistent. It's not about finding the perfect moment. It's about showing up every single time, especially when it feels wrong. Today, we're breaking down Just Keep Buying by Nick Maggiulli, a book that sold over 400,000 copies by doing something radical, telling the truth about money. No hype, no shortcuts, no get-rich-quick schemes, just data-driven principles that actually work. By the end of this video, you'll understand exactly how to save money, when to invest it, and why the simple act of consistently buying assets is the most powerful wealth-building tool you'll ever have. Let's dive in. Chapter 1. Forget saving. Focus on income growth. The book opens by destroying one of the most common pieces of financial advice. Cut your spending and save more. Maggiulli argues this is backwards, especially when you're young. Here's why. Your savings rate is capped at 100%, but your income growth potential is unlimited. Think about this. If you make $50,000 and live on $40,000, you're saving $10,000 a year. A 20% savings rate. That's solid. But even if you cut your spending to the bone and live on just $30,000, you've only increased your savings by $10,000. You're eating ramen, sacrificing quality of life, and you've merely doubled your savings. Now, imagine you focus that same energy on increasing your income. You develop new skills, switch jobs, negotiate a raise, start a side hustle. You go from $50,000 to $70,000. Now you're saving $30,000 while still living on $40,000. That's triple the savings with no lifestyle sacrifice. The math is clear. In the early stages of wealth building, income growth beats spending cuts every single time. Maggiulli backs this up with data, showing that your first decade of earning is the most critical. The income trajectory you establish in your 20s and 30s compounds for the rest of your career. This doesn't mean spending recklessly. It means being strategic about where you focus your energy. Don't obsess over your $5 coffee if you're not obsessing over earning $5,000 more per year. The coffee is a rounding error. The income growth is transformational. The book provides concrete strategies for income growth. First, become undeniably valuable. Develop skills that are in high demand and short supply. Technology, sales, communication, specialized expertise. These are income multipliers. Second, switch jobs strategically. Data shows that people who change jobs every 2-3 years earn significantly more over their careers than those who stay put. Loyalty to your employer often means lower lifetime earnings. Be loyal to your career growth instead. Third, negotiate everything. Your starting salary, your raises, your benefits. Most people leave hundreds of thousands of dollars on the table over their careers because they're uncomfortable with negotiation. Get comfortable or stay poor. It's that simple. Fourth, create multiple income streams. This doesn't mean working 3 jobs. It means building income that doesn't require your direct time. Side businesses, freelancing, content creation, rental income. Every additional stream reduces your dependence on a single employer and accelerates wealth building. Majuli is clear. Save what you can, but spend most of your energy early on increasing what you earn. Once you're earning 100,000, 200,000 or more, then optimize your spending. But until then, grow the top line aggressively. Chapter 2. When to save versus when to splurge. Now that we've established income growth comes first, let's talk about how to actually use that income. The book presents a framework that's both practical and liberating. Spend guilt-free on what matters to you. Ruthlessly cut what doesn't. Most financial advice treats all spending as equally bad. But that's nonsense. $1 spent on something that brings lasting value, joy, or growth is completely different from $1 wasted on something you don't care about. Majuli introduces the concept of spending values. These are the categories where money genuinely improves your life. For one person, that might be travel. For another, it's food. For someone else, it's housing or education or hobbies. The specific categories don't matter. What matters is knowing yours and spending intentionally in those areas. Here's the framework. Identify your top 2-3 spending values. These are where you get permission to splurge guilt-free. Everything else, cut ruthlessly. This is how you live richly while building wealth. The book shares Majuli's personal example. He values experiences and time flexibility, but doesn't care about cars or designer clothes. So he spends generously on travel and work-life balance, drives a used car, and buys basic clothing. No guilt either way because he's aligned with his values. Now let's address the big spending decision most people face. Should you rent or buy a home? The book tackles this with pure data, and the answer might surprise you. In most scenarios, renting and investing the difference outperforms homeownership from a pure financial perspective. Here's why. Homeownership comes with hidden costs people ignore. Maintenance, property taxes, insurance, HOA fees, transaction costs when you sell. When you account for all of this, the true cost of homeownership is often 2 to 3 times your mortgage payment. Plus, your home equity isn't liquid and isn't diversified. Meanwhile, if you rent affordably and invest the difference in diversified assets, you typically build wealth faster and maintain more flexibility. You can move for better job opportunities. You're not tied down, and your wealth is liquid and accessible. But, and this is important, Majuli acknowledges that homeownership isn't purely financial. If owning a home provides psychological benefits, stability for your family, or aligns with your values, then it might be worth the financial trade-off. Just go in with eyes open about the real costs. The key principle: spend intentionally on what you value, ruthlessly cut what you don't, and don't let societal pressure dictate your financial choices. Your money should serve your life, not someone else's expectations. Chapter 3. The case for buying every paycheck. Now we get to the core message of the book. Just keep buying. This isn't just a catchy title. It's a wealth-building philosophy backed by decades of market data. Here's the simple strategy. Every time you get paid, invest a portion immediately. Don't wait for the right time. Don't try to predict crashes or time bottoms. Don't hold cash hoping for a better entry point. Just buy consistently regardless of market conditions. Why does this work? 3 reasons. First, time in the market beats timing the market. Study after study shows that trying to time your purchases results in lower returns than simply buying consistently. Even professional investors can't consistently time the market, so why do you think you can? The book presents compelling data. If you had invested $1,000 per month in the S&P 500 starting in January 2000, literally the worst possible timing, right before the dot-com crash, you'd still have over $600,000 by 2020. You'd have bought through 2 of the worst crashes in history and still crushed it. Second, dollar cost averaging reduces risk. When you buy consistently, you automatically buy more shares when prices are low and fewer shares when prices are high. This averages out your cost basis and reduces the impact of volatility. You're not trying to outsmart the market. You're using math to your advantage. Third, consistent buying removes emotion from investing. The market crashes. Your system says buy. The market hits all-time highs. Your system says buy. You're removing fear and greed from the equation and letting consistency do the work. But here's where people get stuck. What if I buy right before a crash? Maggiulli addresses this head-on with historical data. Yes, buying before a crash feels terrible, but within a few years, you're back to positive returns, and you've been buying cheaper shares the whole time. Long term, it barely matters. The book shares this powerful insight. The best time to start investing was 10 years ago. The second best time is today. Every day you wait, hoping for better conditions, is a day you're not building wealth. So, what should you buy? Maggiulli is refreshingly straightforward. Low-cost index funds, primarily stock index funds for long-term growth. Not individual stocks, not cryptocurrency, not complex strategies, just boring, diversified index funds. Why? Because index funds give you instant diversification across hundreds or thousands of companies, require zero active management, have minimal fees, and historically outperform 80-90% of actively managed funds over long periods. They're not exciting, but they work. The recommended approach: build a simple portfolio of 70-90% stock index funds like total market or S&P 500 funds and 10-30% bond index funds. Younger investors can lean more heavily into stocks. As you approach retirement, shift gradually toward bonds for stability. That's it. No stock picking, no market timing, no complexity. Just keep buying these boring funds every single paycheck and let compound growth do the rest. Chapter 4. The Debt Question. Pay off or invest? One of the most common financial dilemmas. Should you pay off debt aggressively or invest while carrying debt? The conventional wisdom says pay off all debt first. Maggiulli says conventional wisdom is wrong, at least mathematically. Here's the framework. Compare the interest rate on your debt to the expected return on investments. If your debt interest rate is lower than expected investment returns, you should invest. If it's higher, you should pay off the debt. Let's make this concrete. You have student loans at 4% interest. Historical stock market returns average around 10% per year. Mathematically, every dollar you invest, rather than paying extra on your loans, earns you an extra 6% annually. Over decades, that's massive wealth. The book runs the numbers. Someone who pays off $50,000 in student loans at 4% interest as fast as possible versus someone who makes minimum payments and invests the difference. After 30 years, the investor comes out hundreds of thousands of dollars ahead, but Maggiulli acknowledges this isn't purely mathematical. Some debt is psychological burden. If your debt is causing you stress, affecting your mental health, or preventing you from sleeping at night, the psychological benefit of paying it off might outweigh the mathematical benefit of investing. So here's the nuanced approach. High-interest debt, anything above 7 to 8% like credit cards, pay off aggressively. This debt is killing you financially and provides no benefit. Eliminate it as fast as possible. Moderate interest debt, 4-7% like many student loans or car loans, this is a judgment call. The math says invest, but your psychology might say pay off. Choose based on what lets you sleep at night. There's no wrong answer as long as you're intentional. Low-interest debt, below 4% like many mortgages, definitely invest instead of paying extra. Making extra mortgage payments when you have a 3% interest rate while you could be earning 10% in the market is leaving huge money on the table. The book also addresses one critical debt mistake: sacrificing retirement contributions to pay off low-interest debt. If your employer offers a 401k match, that's free money, often 50-100% instant return. Never turn down free money to pay off debt. Always contribute enough to get the full match, regardless of your debt situation. Here's the principle. Be strategic about debt. Don't treat all debt the same. High-interest debt is an emergency. Low-interest debt is a tool that can actually help you build wealth faster by freeing up money for investments that grow faster than the interest accumulates. One final point Majuli emphasizes. Once you do pay off debt, don't inflate your lifestyle with that freed-up cash flow. If you were paying $500 per month on a car loan, once it's paid off, redirect that $500 to investments immediately. Don't let lifestyle creep steal your wealth-building momentum. Chapter 5. Diversification, your only free lunch. Let's talk about the most important concept in investing that most people either don't understand or actively ignore: diversification. Majuli calls this the only free lunch in investing. And he's right. Here's what diversification means. Spread your money across many different assets so that if one fails, it doesn't destroy your entire financial life. This seems obvious, yet people constantly violate this principle. They put everything in one stock, one asset class, one investment, because they're convinced it's a sure thing. The book shares sobering examples. Employees who kept their entire net worth in company stock, Enron, Lehman Brothers, WorldCom. People who went all in on individual stocks that looked like sure bets, only to watch them collapse. Real estate investors who owned multiple properties in one city then faced a local market crash. In every case, lack of diversification turned financial success into catastrophic failure. All it takes is one concentrated bet going wrong to wipe out decades of wealth building. So, how do you diversify properly? The book presents a clear hierarchy. First level, diversify across individual companies. Don't own just one stock. Own hundreds or thousands. This is why index funds are so powerful. When you buy an S&P 500 index fund, you own 500 companies. If one fails, it barely affects your portfolio. Second level, diversify across asset classes. Don't just own stocks. Also own bonds, real estate, maybe some commodities or international assets. Different asset classes perform differently in different economic conditions, providing stability. Third level, diversify across time. This is what dollar-cost averaging accomplishes. By buying consistently over many years, you diversify when you're buying. Sometimes it peaks, sometimes it valleys, averaging out over time. Fourth level, diversify across geographies. Don't just invest in your home country, include international exposure. The U.S. market has historically performed well, but there have been decades where international markets outperformed. Diversification protects you regardless of which region dominates. But here's where Majuli pushes back on conventional diversification advice. You can over-diversify. Some financial advisors recommend owning 20 different asset classes, rebalancing constantly, making investing incredibly complex. That's not necessary, and often reduces returns. The book advocates for sufficient diversification, not maximum diversification. A simple 3-fund portfolio covers you completely. U.S. Total Stock Market Fund, International Stock Market Fund, and Bond Fund. That's it. You're diversified across thousands of companies, multiple countries, and different asset classes. Adding complexity beyond this doesn't significantly reduce risk, but does increase costs and effort. One critical form of diversification people forget: income diversification. Don't rely on a single source of income. We talked earlier about multiple income streams. This is diversification applied to your earnings, and it's just as important as investment diversification. The book also addresses one dangerous form of false diversification: owning multiple funds that all do the same thing. Someone might proudly say they own 5 different mutual funds, but if all 5 are U.S. large-cap growth funds, they're not diversified. They're concentrated with extra fees. True diversification means ensuring that if one thing goes wrong, one company fails, one sector crashes, one country enters recession, one asset class collapses, your financial life continues without catastrophic damage. Majuli's ultimate message on diversification: keep it simple but thorough. Own broad index funds across major asset classes. Don't try to pick winners. Don't concentrate in individual stocks unless you can afford to lose that money. Boring diversification builds reliable wealth. Chapter 6. How to think about market crashes. Market crashes are inevitable, not possible, not likely, inevitable. If you're going to invest for 30, 40 years, you will experience multiple significant market declines. The question isn't whether you'll face crashes, but how you'll respond when you do. This is where most investors destroy their wealth. They panic, sell at the bottom, and lock in losses. Then they wait for things to feel safe again before buying back in, missing the recovery. This pattern is so common and so destructive that Majuli devotes an entire chapter to fixing it. First, understand what a crash actually is: a transfer of wealth from the panicked to the patient. When the market drops 30, 40% and everyone is selling in, terror. Where do you think that stock goes? It goes to the people who are buying, the people who kept their heads while everyone else lost theirs. The book presents historical data that's both sobering and encouraging. Yes, the market crashes frequently. Since 1950, there have been dozens of 10% plus declines, over a dozen 20% plus declines, and several 40% plus collapses. If you invest long-term, you'll experience all of these. But here's the other side. Every single crash in history has been followed by recovery and new highs. Every single one. The market has crashed and recovered through world wars, nuclear threats, oil crises, terrorism, pandemics, financial collapses, and political chaos. And yet, long-term trajectory, up. Majuli shares a powerful reframe. Market crashes aren't disasters for long-term investors. They're sales. Everything you've been buying is now 30 to 40% off. If your favorite store had a 40% off sale, would you avoid it? No. You get excited. Treat market crashes the same way. This is why the just keep buying philosophy is so powerful during crashes. While everyone else is selling and running for safety, you're calmly continuing your systematic purchases, buying shares at bargain prices that will look brilliant in 5 years. The book provides strategies for surviving crashes psychologically. First, never look at your portfolio during a crash. Seriously. What benefit comes from watching your account balance drop? It only triggers panic and bad decisions. If you're investing for 30 years, what happens in the next 30 days is irrelevant. Second, remember why you're investing. You're not investing for next month or next year. You're investing for decades from now. A crash that looks catastrophic on a 1-year chart barely registers on a 30-year chart. Third, automate everything. When your investments are on autopilot, automatically pulling from your paycheck and buying your chosen funds, you remove the opportunity to panic and stop. The system keeps buying whether you're scared or not. Fourth, increase contributions during crashes if possible. This is advanced mode, but if you have extra cash during a market crash, it's the best time to invest. You're buying at a discount. The people who bought heavily during March 2020 or March 2009 made extraordinary returns. But my Julie also addresses a critical point. Don't try to catch the exact bottom. You can't. Nobody can. Some people convince themselves to wait during a crash because surely it will drop more. Then they miss the entire recovery waiting for a bottom that already happened. The book's approach: ignore the crash, keep buying according to your plan. Don't try to be clever. Don't try to time it. Just persist. The crash will end. They always do. And you'll have been buying shares on sale the whole time. One final insight about crashes. They're actually necessary for long-term wealth building. Without crashes providing lower entry points, returns would be lower across the board. Volatility is the price you pay for higher long-term returns. Accept it, embrace it, profit from it. Chapter 7. When can you actually retire? Let's talk about the finish line, retirement. After years or decades of just keeping buying, when can you actually stop working? The book provides a clear, data-driven framework. The traditional retirement calculation is simple. Multiply your annual spending by 25. That's how much you need saved. If you spend $40,000 per year, you need $1 million. If you spend $80,000 per year, you need $2 million. Why 25? This comes from the 4% rule we discussed in the previous book summary. If you withdraw 4% of your portfolio per year, which is 1/25, your money should last through a 30-year retirement in any historical market scenario. But Maggiulli adds important nuance. First, that 4% should be your spending from your portfolio, not your total spending. If you have Social Security providing $30,000 annually and you need $70,000 total, you only need to withdraw $40,000 from your portfolio, meaning you need $1 million saved, not $1.75 million. Second, the 4% rule is conservative. In most historical scenarios, you'd end up with more money than you started with after 30 years following the 4% rule. If you're comfortable with some risk, you could safely withdraw 4.5 to 5% in many cases. Third, retirement spending isn't static. Most people spend more in their 60s, less in their 70s, and even less in their 80s. Planning for flat spending across 30 years might be overly conservative. The book also introduces the concept of coast fire, the point where you have enough saved that even if you never contribute another dollar, compound growth will get you to your retirement number by your target retirement age. For example, if you're 30 and want to retire at 60 with $2 million and you already have $400,000 saved, you've hit coast fire. That $400,000 growing at 8% annually for 30 years will reach $4 million without additional contributions. You can stop saving for retirement and use your income entirely for current lifestyle. This is a game changer psychologically. Many people reach coast fire in their 30s or 40s and don't even realize it. They keep grinding and saving when they could actually relax and enjoy life more, knowing their future is already secured. Maggiulli also addresses a critical mistake, retiring too early. Not because you can't afford it, but because you haven't thought through what you'll actually do with your time. The book shares research showing that early retirees often struggle with purpose and identity unless they've planned for meaningful activities. Retirement isn't the goal. Financial freedom is. Freedom to work on what matters to you, whether that's paid or not. Freedom to spend time how you choose. Freedom from financial stress. Sometimes that looks like traditional retirement. Sometimes it looks like working part-time on passion projects. Sometimes it looks like continuing your career, but knowing you could stop any time. The book's recommendation, once you hit your financial independence number, don't necessarily retire immediately. Give it a year. Try extended time off. Experiment with the lifestyle. Make sure financial freedom actually improves your life before making it permanent. Finally, Maggiulli emphasizes, the number is less important than the consistency of getting there. Someone who saves 20% of their income consistently for 30 years will reach financial independence regardless of their income level. Someone who saves sporadically will struggle regardless of how much they earn. Focus on the process, just keep buying, and the outcome takes care of itself. The simplicity of wealth. Let's bring this full circle. Just keep buying presents a wealth-building philosophy that's radically simple in a world that profits from making everything complex. You've learned that income growth beats spending cuts, especially early in your career. Every hour spent increasing your earnings has more impact than every hour spent optimizing your budget. You've discovered the framework for intentional spending. Splurge guilt-free on what truly matters to you, ruthlessly cut everything else. Your money should serve your values, not society's expectations. You've understood the core message. Just keep buying. Every paycheck, invest consistently, regardless of market conditions. Time in the market beats timing the market every single time. You've learned when to pay off debt and when to invest despite having debt. High-interest debt is an emergency. Low-interest debt is a tool that can actually accelerate wealth building. You've seen why diversification is the only free lunch in investing, and how simple diversification through index funds provides all the protection you need without unnecessary complexity. You've learned how to think about market crashes, not as disasters, but as sales. The patient investors who keep buying during crashes are the ones who build extraordinary wealth. And you've calculated when you can actually achieve financial independence, when your portfolio reaches 25 times your annual spending from that portfolio. But here's what matters. This isn't theoretical knowledge. This is actionable strategy. The question is, will you act? Here's your implementation plan. First, calculate your current income and identify one concrete action to increase it by 10-20% in the next 12 months. Whether it's a job switch, a raise negotiation, or a side income stream, commit to it. Second, automate your investments today. Set up automatic transfers from your paycheck to your investment accounts. Decide on a percentage, 10%, 15%, 20%, and make it automatic. Remove the decision from your future self. Third, choose your investments. A simple portfolio of low-cost index funds, total stock market fund, international stock fund, bond fund. That covers you completely. No individual stocks, no complexity, no trying to be clever. Fourth, commit to the long-term plan. Write down your target retirement number. Calculate how long it will take with your current savings rate. Put that date on your calendar. Then commit to just keep buying until you hit it. Fifth, prepare for the psychological challenge. At some point, the market will crash. Your portfolio will drop 30-40%. You'll feel panic. Remember this moment right now when you're clear-headed. Your future panicked self needs to trust your current rational self. The plan is to keep buying. Don't deviate. Remember my Julie's ultimate insight. Building wealth isn't about intelligence, luck, or finding some secret strategy. It's about consistency. The person who saves 15% of their income for 30 years becomes wealthy. The person who saves sporadically, tries to time the market, and chases complexity usually doesn't. Wealth building is boring. It's the same simple action repeated thousands of times over decades. It's not exciting. It's not glamorous. And it doesn't make a good story at parties. But it works. Just keep buying. Through bull markets and bear markets. Through promotions and layoffs. Through economic booms and recessions. Through optimism and panic. Just keep buying. Your wealthy future self, financially independent, stress-free, full of options and freedom, that person is built one paycheck at a time, one investment at a time, one day of consistency at a time. The best time to start was 10 years ago. The second best time is right now. Stop overthinking. Stop waiting for perfect conditions. Stop looking for complexity. Just keep buying.